This is the first video in a series breaking down Jesse Livermore's book, How to Trade in Stocks, chapter by chapter. Everything you hear comes directly from his writing, his own words, his own failures, his own lessons. No interpretation, no fluff. Just what Livermore actually said about speculation, applied to modern futures trading. Chapter 1 is about one thing: patience, or the lack of it, and how that single weakness destroys accounts. Here's how Livermore opened his book.
The game of speculation is the most uniformly fascinating game in the world, but it is not a game for the stupid, the mentally lazy, the man of inferior emotional balance, nor for the get-rich-quick adventurer. They will die poor.
He didn't sugarcoat it. If you're looking for quick money, you're already finished. Livermore wrote this after 40 years of experience. 40 years of studying markets, keeping records, developing systems, and despite all that knowledge, he admitted something most experts never would. He said,
"There have been many times when I, like many other speculators, have not had the patience to await the sure thing. I wanted to have an interest at all times."
Read that again. Even after decades of experience, he couldn't control the urge to always be in a trade. He knew better. He had the data. He understood the principles, but he was human. He asked himself the same question you're probably asking. With all your experience, why did you allow yourself to do so? His answer:
I am human and subject to human weaknesses. Like all speculators, I permitted impatience to outmaneuver good judgment.
That's the enemy. Not the market. Not the prop firm rules. Not your strategy. Impatience. Livermore compared it to poker.
Speculation is very similar to playing a game of cards, whether it be poker, bridge, or any similar game. Each of us is possessed with the common weakness of wanting to have an interest in every jackpot, and we certainly would like to play every hand at bridge.
Every trader wants action. Every setup looks tradable when you're sitting there watching price move. But that urge to always have skin in the game, that's what kills accounts. Livermore described exactly how this pattern plays out. You form an opinion about a stock or market. You believe it's going to move, but instead of waiting for confirmation, you act immediately. Here's what he wrote.
Believing it to be right, he acts immediately, only to find that after he has made his commitment, the stock goes the other way. The market becomes narrow, he becomes tired, and goes out. Perhaps a few days later it begins to look all right, and in he goes again. But no sooner has he re-entered it than it turns against him once more. Once more he begins to doubt his opinion and sells out. Finally, the move starts up. Having been too hasty and having made 2 erroneous commitments, he loses courage.
That's your last 10 futures trades, isn't it? You see the setup. You enter. It goes against you. You exit. You wait. You enter again. It goes against you again. You exit. Then the real move happens without you. And by that point, you've burned through half your max drawdown, and you're too scared to take the trade when it finally arrives. Livermore's solution was simple but difficult. Wait for confirmation. Don't be the first one in. Wait until the move proves itself. He gave a specific example.
Say, for instance, a stock is selling around $25 and has been holding within a range of $22 to $28 for a considerable period. Assuming that you believe that the stock should eventually sell at $50 and it is $25 at the time, have patience and wait until the stock becomes active, until it makes a new high, say around $30. You will then know that market-wise you have been justified.
In other words, don't buy in the range. Wait for the breakout. Wait for proof. He continued.
That is the time for you to back your opinion. Don't let the fact that you did not buy at $25 cause you any aggravation. The chances are, if you had, you would have become tired of waiting and would have been out of it when the move started.
This applies directly to futures trading. NQ is sitting in a range. You think it's going higher. You could buy in the middle of the range and hope. Or you could wait for it to break out, prove the move is real, and then enter. Livermore's approach? Always wait for confirmation, even if it means entering late, even if it means missing the bottom tick. He wrote,
Experience has proved to me that the real money made in speculating has been in commitments in a stock or commodity showing a profit right from the start.
The best trades work immediately. They don't require patience while underwater. They don't require averaging down. They start profitable and stay profitable. How do you get those trades? By waiting for the psychological moment. Livermore's term for when the move is so strong it has to carry through. But here's the hard truth he learned.
There are times when money can be made investing and speculating in stocks, but money cannot consistently be made trading every day or every week during the year. Only the foolhardy will try it. It just is not in the cards and cannot be done.
You cannot trade every day and make money. The market doesn't move every day. Real opportunities are rare, and forcing trades when they're not there is how you blow accounts. Livermore put it even more directly.
There are times to speculate, and just as surely there are times when one should not speculate.
Most of the time, you should be doing nothing. Waiting, studying, preparing, not trading. For futures traders, this is critical. Whether you're trading prop firm evaluations or your own capital. Every forced trade costs you. Every impatient entry burns through your buffer. And when the real setup finally arrives, you're either out of attempts or too damaged psychologically to take it. Livermore understood the fear and hope reversal that destroys traders. He described it perfectly.
You buy a stock at $30. The next day it has a quick run-up to $32 or $32.50. You immediately become fearful that if you don't take the profit, the next day you may see it fade away. So out you go with a small profit, when that is the very time you should entertain all the hope in the world.
Then he flipped it.
On the other hand, suppose you buy a stock at $30, and the next day it goes to $28, showing a 2-point loss. You would not be fearful that the next day would possibly see a 3-point loss or more. No, you would regard it merely as a temporary reaction, feeling certain that the next day it would recover its loss. But that is the time that you should be worried.
Fear on winners, hope on losers. That's backward, and it's killing your account. Livermore's rule.
Profits always take care of themselves, but losses never do. The speculator has to insure himself against considerable losses by taking the first small loss.
Cut losses immediately. Let winners run. It's simple, but impatience makes you do the opposite. He was obsessive about one thing: never average down. Never add to a losing position hoping it will turn. He wrote,
It is foolhardy to make a second trade if your first trade shows you a loss. Never average losses. Let that thought be written indelibly upon your mind.
If your first trade is wrong, you get out. You don't add to it. You don't hope it reverses. You take the small loss and wait for the next setup. Livermore also had a rule about trend following.
I never buy on reactions or go short on rallies.
He waited for trends to establish, then followed them. He didn't try to catch bottoms or tops. He didn't buy dips in downtrends or short rallies in uptrends. He waited for confirmation, then moved with the trend. For prop traders, this means something specific. You're not paid to predict reversals. You're paid to pass the evaluation. And passing requires capital preservation while waiting for high-probability setups. For traders using their own capital, the principle is the same. Protecting your account matters more than being right on every move. Livermore said it this way:
The speculator has to be his own insurance broker, and the only way he can continue in business is to guard his capital account and never permit himself to lose enough to jeopardize his operations at some future date when his market judgment is correct.
Your capital is your max drawdown. Every forced trade threatens it. Every impatient entry reduces your remaining attempts. And when you finally get the right setup, you need capital left to take the trade. Livermore spent 40 years learning these lessons. He made fortunes and lost them because he kept breaking his own rules. He knew what to do, he wrote it down. But he was human. And humans want action. The difference between Livermore and most futures traders: he had unlimited attempts to learn these lessons. You don't. Whether you're trading prop firm evaluations with strict rules or your own capital that took months to build, you have to learn this now, not over decades. Here's what Livermore recommended.
I believe anyone who will take the time and trouble to study price movements should in time be able to develop a guide which will aid him in future operations or investments.
Keep records. Study when real moves happen. Identify the conditions that precede breakouts. Then wait for those conditions to appear before you trade. He was emphatic about this.
You must keep your own records. You must put down your own figures. Don't let anyone else do it for you. You will be surprised how many new ideas you will formulate in so doing, ideas which no one else could give to you because they are your discovery, your secret, and you should keep them your secret.
The work isn't learning new strategies. It's learning when to trade versus when to sit still. And that only comes from studying your own data. Livermore's final point in Chapter 1. Most people think investors are conservative and speculators are gamblers. He said the opposite is true.
From my viewpoint, the investors are the big gamblers. They make a bet, stay with it, and if it goes wrong, they lose it all. The speculator might buy at the same time, but if he is an intelligent speculator, he will recognize, if he keeps records, the danger signal warning him all is not well. He will, by acting promptly, hold his losses to a minimum.
In other words, the disciplined speculator who cuts losses and waits for setups is safer than the investor who buys and hopes. That's Chapter 1. One lesson: you can't make money trading every move. You have to wait for the psychological moment. And the only way to identify that moment is by keeping records and having the patience to do nothing until conditions align. Livermore kept his records by hand. Today, you have tools that do the heavy lifting. If you're serious about tracking when real setups occur versus when you're just forcing trades, check the links below. Platforms for charting, backtesting, journaling, automated analytics, psychology tools, trade sync, and prop firm funding. If this helped, subscribe for the rest of the series. We'll break down every chapter of Livermore's book, applying his principles to modern futures trading. Order filled, helping you see the game clearly so you don't get played. Educational only, not financial advice. Futures trading carries risk. Protect your capital.